Hi there, this is Christian Dai and Sima. Sima, how do you pronounce your last name?
Well, Farsi Mirzaaghaee, the kind of English version is Mirzaaghaee.
Sure, I didn't even want to try, but
Okay.
today we are here to talk about preparing for 2023's the real estate market. So there's four topics that we're going to talk about. Investment properties outside of BC. If you're new to this country, what are the investing rules that apply to you? And whether you should rent or buy, especially in this very, very high interest rate and very expensive market times. So the pros and cons, and insurance options for those people who are starting out or those people who are real estate investors. So I think we should dive right into it. And a quick disclaimer that the information today is not to be considered as real estate or mortgage advice. This is just for educational purposes only. What we do ask is that you work with a trusted professional, such as ourselves, or with someone else, in order to make a real estate or mortgage decision. So one of the first things that we want to talk about is if you are new to Canada, what are the rules when it comes to buying property as well as mortgage rules? So Seema, I'm going to turn it over to you, and you are, of course, on the mortgage broker side. So please let us know what are some of the rules.
Okay.
Would you like to share your slide now?
Yes, please.
Okay, you can go ahead.
Okay. Let me just make it full screen. Okay, can you see my screen?
Yes.
Perfect. Okay. So basically, I start with newcomers, people who are first-time home buyers. Actually, first-time home buyer is not necessarily a newcomer, but basically we are referring to newcomers and first-time home buyers here in general. The first thing that you may be interested is that some people who are first-time home buyers, especially newcomers, when they talk to me, they say that, okay, what is that money that government is basically giving for down payment? So I want to share a calculator with you, and you will see that this basically government has created this plan for first-time home buyers. You can see the calculator. And government is saying that, okay, you either want to buy an existing real estate or a new construction. If you put if your property, the only way that you can be included in this program or benefit from this program is if your property is $500,000 or less. So if your property, your home price is $500,000, and for example, your annual household income is $120,000, you put 10% down, which is $50,000 of the value of the house, and then you're eligible to benefit from this plan. The government will basically put 25%, $25,000 down payment for you, added to your $50,000. So now you're putting $75,000 down, and you will be exempted from property transfer tax, which is $8,000 in this case. It has its own formula. So basically, and you can, if you have saved in your RSP, you can use up to $35,000 for a single person, $70,000 for a couple to use for your down payment. So if you use this plan, your mortgage payment will go down a lot because you're using all these things, especially these two, to reduce your mortgage amount. Exactly the same thing happens for the new construction. The only difference is instead of $25,000 government share is $50,000 share. So they put $50,000, which is not bad. These were the pros of this basically plan program. The cons of this is the government will be basically, you are not the only owner of your property. When you sell your property, then you have to pay the government's money back plus a share of your profit. So that's something that people sometimes they are not interested, and it's a little bit complicated for the banks when they want to go and basically approve you for your mortgage. It's a little bit more complicated. The documents and all these credit score and all these things are not easy. So, but I thought that as a first-time home buyer or as a newcomer, you may be interested to know about this. Then next, I talked about RRSP. I don't go to the details of RRSP, but you know that you can withdraw $35,000 from your RRSP or $70,000 as a couple, but you have to put it back into your RRSP in 15 years. The other thing that is very important when I talk to people, especially immigrants, are under age 50 years old most of the time. And that's the age that they are income producer. So when we are income producer, people bring money from, for example, an apartment, they sell their apartment or their house in Iran, they bring the money and they want to buy a property and go and live in that property. Now they have to work, they have to find a job, they have to create an income to be able to pay for the monthly mortgage. Instead of that, usually I talk to people, especially now because I know a little bit more about commercial mortgages and business loans. I encourage people that, okay, why don't you invest in a commercial property? Why don't you think about getting a business loan to create income? First of all, build your base, financial, basically build the base of your financial situation. And then after that, when you create more income, you can either pay rent or you can buy a property as a residential. So this is also another thing that as a first time, as a new comer or as an immigrant, or even as a person who is living in Canada and is thinking that to buy another property and rent it, may think about, oh, how about if we buy a commercial property? That's another thing. The last thing that I want to talk is about, okay, most of the time people ask me, can I buy a property with 5% down or 10% down, or should I put 40% down? So there are two types of mortgages. One is insured mortgage and another one is uninsured mortgage. If you put less than 20% down, you are basically under the category of insured mortgages. And for this, for example, he is giving an example. If the purchase price is $500,000 in Vancouver, it's not easy. Chris will talk about that, give you more information about the other areas that you can invest. If you find a property $500,000, with minimum 5% down, if you have a solid income, good credit score, if we can get the approval from the banks, then the purchase price, then you can buy 5%, 95% mortgage, and you're basically you have insured mortgage. If you go above $500,000, you for the first 500 you put 5% down, and for the rest of it you put 10% down. So basically, this is a insured mortgage, and you have to pay for CMHC insurance, which is not low. Basically, you have to, because you are high risk client for banks and financial institution, banks, CMHC will insure you, basically will insure the bank, if the homeowner cannot pay the mortgage and it goes to default, then the CMHC will pay the amount of mortgage to the bank. So that is something that you will have to remember. On top of the down payment, you need to also, this will be added to your mortgage, but you are putting also, it depends on the amount of your down payment, you have to pay for the CMHC insurance premium. The last thing is about three types of lenders. We have three types of lenders. People think that, okay, it's only banks. Banks are great, but they have to follow the government guidelines. So it's very difficult. You have to have a good credit score, reliable income. They look at all these things, and they are very strict about, if you have heard, total debt service ratio or gross debt service ratio. They are very strict about TDS and GDS. And if you go even 0.5% above that, they will not approve you. So the other option that you have are B lenders. B lenders are exactly financial institutions. They give you loans and mortgages, but they are a little bit more flexible. So many Canadians, especially people who are looking for the second property, and nowadays it's very difficult to go and get a mortgage from an A lender, they go and they apply with a B lender. And the last one is just people who are really is saying here, usually they don't have a good credit, they don't have a good income, they are looking for a private lender. They are looking for a mortgage or a loan, we go to private lenders for them. The bad thing about here is between 2 to 4% fee. They charge flat fee based on the amount of your loan or mortgage. But it is very good to know that I'm an independent mortgage broker and also independent financial advisor. So when you work with an independent mortgage broker, I have access to all these different lenders, and believe it or not, the list is unlimited. Like, we can go and shop around and check the rates. I don't talk about the rates today because it's very volatile, but we have access to all these different lenders, and we can just basically play with the rates. That's all for me. And Chris, please take I think it's your turn. I don't know if you want to talk about insurance or other.
No, we could switch. We could save the questions to the
Or
end.
also, if you want to add anything that you think, because you're in the real estate investment, to these things that I missed it because of the time, please feel free to
Yeah,
add.
no. That was wonderful. You did a fantastic job over here. I think really it's a matter of, if you are thinking of buying, you really should set up a time with Sima and then explore your specific scenario. Sima, can you just hit the stop share on your side? Perfect. So what I want to talk about next, here, let me just, what I want to talk about on my side now is sort of investment real estate. So Sima has now let us know that there's all these different ways for people to buy real estate, but everybody on this call is here in Vancouver area. So here in BC and Lower Mainland, and of course, our housing price is very, very expensive. So for some people, they said, well, why don't I buy here in Vancouver? I want to buy real estate in Vancouver, but I don't have enough down payment because our housing price is too high. Then one thing that you might consider is to buy out of province or out of the Lower Mainland. So my financial practice, with my background, is I have a financial practice, also RSP license, insurance license, but the unique part about my practice is we help our clients to also find investment real estate properties. And that's what makes us a little bit unique. So if they had, a certain amount of money, let's say $100,000, we might compare it against, what does it look like if we put it into your RSPs? Well, what does it look like if we put it as a down payment on a home? And for some people, they might say, well, I want to invest in real estate, but the home that I want is, let's say, $1.3 million or $1.5 million, and they don't have quite enough of a down payment in order to buy that property, but they want to buy real estate. Then a solution might be, well, why don't we buy real estate elsewhere, build up the equity, and then when the equity is large enough, then sell the real estate in order to buy your own property, or to keep it just as an investment. But then the question is, well, where do we buy this real estate? So I'm not going to tell you exactly the city and the exact street, because that's essentially what I do for clients. And if you were interested in having me and my team find these properties for you, then I encourage that you connect with us. What I do want to show you is what's out there, and the provinces that we're looking at. So I want to first address the question, is real estate in Canada going to go down? And then the answer is no, not in the long term. In the short term, sure, we might go down 10%, 5%, but in the long term, no. And this is the reason why. Canada does not have enough housing for the amount of immigration that's coming in. Canada does not have enough housing for the amount of the current population that is looking for housing. So the number of homes per 1,000 people in Canada is actually one of the lowest, which means we have a supply issue. When you have high demand and you have low supply, you're going to have high housing prices. Okay. So an immigration report by province over the next 20 years, this is projected from 2019 to 2043. This is the annual percentage that Canada's population will go up. And the answer is 9.1%. However, look at the different provinces that are expected to go up. BC and Alberta, BC and Ontario have always been very, very popular provinces where people want to live. So new immigrants, when they come here, they want to say BC, they want to say Toronto, sort of those two areas. But if you look right now, Alberta has a 16.6% annual expected rate. Now, has this been proven? Absolutely. Since 2018 to 2022, now we're 2023, they've had this percentage increase. I personally have 2 clients that are moving to Alberta this year. And why? More affordable housing. So a quick little statistic for you. The average household in BC makes about $80,000 per year. The average household in Alberta, especially Calgary, Edmonton area, makes about $110,000 per year. So they actually have higher incomes, but the average house in Vancouver is about $2 million. The average house in Alberta, especially Calgary, Edmonton area, is about $500,000. So you have a significantly less expensive house for a population that makes significantly more money. So if I was, we have people who are moving to that area, and you also have people who are immigrating to that area. And they're not the only one. We take a look at Saskatchewan, we take a look at Manitoba, as well as you take a look at some areas in the Maritimes. So what I want to do is I want to kind of first say, BC is not the only place to invest, and we're very, very expensive. So the highest population rates, you take a look at some of the cities. So the one that I kind of want to look at over here is, if we look down this list, we have a couple in Ontario, Oshawa, Kitchener, Waterloo, one in BC, which is Kelowna area. But then you've got also Calgary, Saskatoon, and then you've got Moncton. So these are the fastest growing ones. And what you'll notice is that BC is not, and Vancouver is not very fast growing as well. So when we talk about, well, Christian, how do you invest in real estate? What do you look for? So there's 3 metrics that we look for with our company, and we look for something that is called the cap rate. And the cap rate is a way to compare 2 different pieces of real estate. You want the highest possible percentage when you're comparing cap rate, because the formula is net operating income, and that's rent minus expenses, divided by the purchase price. And so the cap rate will be a percentage. The higher the percentage, the better. The second thing we look at is cash flow. And cash flow is a little bit easier. All the money coming in from rent and all the money going out, mortgage, strata, property tax, vacancy. So if the number is positive, that's great. That means, 20% down payment, which is what you need in Canada for investment property. So I put 20% down payment, and does this cash flow? In BC, the answer is absolutely not. Vancouver, you're probably going to be deeply. In order to get something to cash flow in BC, like in Vancouver area, I would say you're going to need somewhere between 35 to 45% down payment just to get the rent to break even, especially at today's high interest rates. So it's very, very, very high. So on a, for example, on an $800,000 property, you'd have to put almost $350,000 just to get it to cash flow. So that same $350,000, we could easily use that as a 20% down for, $1 million property. Like we wouldn't even need the 300. We'd only need 200,000 for $1 million property outside. So cash flow is the next one, and the internal rate of return is the third most important. The internal rate of return is the percentage, the annual percentage that we can expect our money to achieve. So the reason why we use the internal rate of return is because it compares it against the stock market. So if you said, well, Christian, why should I invest? Why don't I take my money and I'll go to the stock market? If you go to the stock market, what are you going to get? 6%, 8% maybe? Right now, the stock market is down 17%. So you're going to get these fluctuations. Whereas if I invest in this real estate and hold it for 10 years, what will be my return, Christian? If I invest it for 20 years, what will be my internal rate of return? So we use these three numbers in order to help to guide us whether the investment makes sense or not. So let's dive in. Here is out of province, not in BC, a 2-bedroom condo. Oh, sorry, I apologize. This is a 2-bedroom condo in BC. This is in Vancouver area. It's $750,000 for a 2-bedroom condo. And for those of you in BC, you're going to realize that's about right. So when me and my team analyze it, it's a 20% down payment. We're going to generate about $2,800 a month in rental income. We're going to put in property management fee. We're going to put in how much we expect that this property will appreciate. We're projecting, because it's Vancouver, 6% capital appreciation annual, which is very high for Canada, but it's about average here for BC. So where are my three numbers? So my first number is my cap rate, 2.9%. For real estate investors, that's not very good. Where's my cash flow? Negative $1,500 per month. Right away, that's terrible. Negative $1,500 per month is terrible. And what is my internal rate of return? About 10.74%. So the reason why we analyze this is so that we can compare it to what else is out there. So if you were to say, well, if I was to buy this property, what would it look like? The cash on cash return would look terrible. It looks negative every single year. But if it appreciated at 6%, and you could handle the negative cash flow, and you sold it after 10 years, then it did go up in value. You would have made money. But I don't know if your stomach could handle $1,500 a month in loss. So now if we, say, well, what if we put it as 35% down? We put it at 35% down, and instead of a long-term rental, we make it a short-term rental. So now the numbers look break even. So this is what I needed to do with my client to say, the only way you're going to make money with no negative cash flow is you have to turn this into a corporate rental. You have to put 35% down payment. Is this a smoking good deal? Not really. It's not really a smoking good deal. So in BC, it's going to be very, very, very hard. So this is what people, whenever somebody wants to do a pre-construction, I always say, let's run the numbers and let's see if it makes sense. Right now, in my opinion, and you could have a different opinion, but in my opinion, if you're doing a pre-construction, the only thing you're gambling on is capital appreciation. You will not be getting cash flow. You'll just be getting capital appreciation. There are exceptions to this, especially if you could do short-term rentals. And we are coming across a couple decent short-term rentals. I wouldn't say they're smoking good deals, but at least they're not cash flow negative. So now I'm going to shift gears, and it says, well, what if we did a condo that I help to find? That's a service that I do, but it's outside of BC. So this is a real example. This is a condo out of BC. It's Airbnb qualified. It's near a major city, and it costs $350,000 for this condo. It's 2-bedroom, and we're looking at about $165 per night. At $165 per night, we're expecting a 70% occupancy throughout the year because it's Airbnb. But the numbers look fantastic. The numbers look really, really good. We have a cash flow of over $600 a month. We have a cap rate of 7.2 cap rate, and our internal rate of return is almost 20%. Almost 20% internal rate of return. Now, because interest rates change, because all of these different variables change, it's most important that we run your real numbers. Like, I don't know what your real number is. If your mortgage rate is 6%, then I would want to run it at 6%, you see. If the place that we found maybe has a, 60% occupancy rate, then we want to run that. So we want to work with our clients to find these properties. And one of the services that I give is that I help them to find them because many of them don't know the areas. So here we have a cash on cash 21% return, and our internal rate of return is going to be a fantastic double-digit return as well. So this to me, and this property wasn't, there 5 years ago. This little property was there like 1 month ago. So this is something that's currently out there right now. So here we're used to houses that are worth $2 million. Here's a house out of BC that is $520,000. If you were to rent it out, it would generate about $2,500 a month in rent. Property taxes about $3,000. So this guy's pretty close to break even. It's pretty close. It's about $100. That $100, rent increases within 1 year, 2 years. That rent will be completely break even. It's a 4.52% cap rate, and it's got an 11.39% internal rate of return. Again, this one is outside of BC. This one is on the East Coast, 450,000. This one is turned into a student rental. With a student rental, you get a much higher amount. So this is now over 3,000. Really, really strong numbers. We're looking at a $900 a month cash flow, 7% cap rate, 21% internal rate of return. So the reason why I show this, but unfortunately I can't give you the exact addresses or the cities, is I'm just showing you that it is possible to invest outside of Canada. The mortgage rules stay the same as if you're investing in BC or out of BC. So for some people who are thinking of becoming investors and to parking their money in real estate, let it grow, then utilize the value later, and then just continue to rent. It's a really good option over here. For some people who qualify, and I know Sima mentioned a multi-unit commercial. This over here is a 5-plex, and it's only 1.3 million. Here in Vancouver, 1.3, that's like that's like a townhouse. But here, 5 units, a 5-plex out of BC, you're going to get about $6,000 a month in rent. You're not going to get $6,000 a month of rent in a townhouse, right? So we ran the numbers on this, and it depends on how much rent that you're generating. It does have some negative cash flow over here, but that could be compensated if you could add value to increase the rents. So a lot of these multiplexes, sometimes you could split it up more, sometimes you could run them as Airbnb. So there are different ways to do it. This one over here is a new build. This is a new construction. So this is 4 units, 4 single-family homes, 4 units, and it's only $2 million. It's only $2 million. So this one over here, the potential monthly rent once it's built is about $14,000 per month of income off of the 4 units. When I run this, huge cash flow, really good cap rate. Plus it comes with a warranty. I think it's a 10-year warranty on the new build. So the reason why I show this is to say there are properties outside of BC. You could probably, if you want to try to find them on your own, absolutely find them on your own. If you're having trouble finding them on your own, or if you don't have the connections to maybe, get the property manager, then you want to work with my team. So me and my team, we're financial advisors, but we focus on real estate investors, and we charge a fee for service, to help people to do that. So if you're interested, I'll share my contact information. Like I said, if you could find it on your own, then you don't need me. But if you can't find it on your own, or you're not that confident or buying something out in these areas because you're not sure how to analyze it, then absolutely, we offer our service to do that. So what's our conclusion? Canadian real estate has always been a good long-term investment. Investing in BC is a good investment, but sometimes people can't afford it. So then we say, keep investing, but maybe look outside of BC. Location is important, but cash flow is actually more important. So you got to be careful if you're buying a place with negative cash flow. We want to sort of talk about how long it'll be negative and how much it'll be negative. So I always say, look at the 3 fundamentals if you are going to invest: cap rate, cash flow, and the internal rate of return. They're not that easy to calculate, especially the internal rate of return. So if you're having trouble, you absolutely want to involve me and my team, okay? So if you did want to connect, there's my contact information to connect with me. If you wanted to have a complimentary conversation about some real estate investing, and I'll either point you in the right direction, or I'll show you how we could work together, okay? So the next conversation, and Seema and I are going to talk about this together, is rent versus buy. So should I rent or should I buy? So Seema, tell me a little bit. If one of your clients was asked you, should I rent or should I buy? What would your response be? Here in 2023, interest rates are high. Would you encourage them that they rent or they buy?
So that's a very good question. First of all, thank you so much for all the good information, Chris. I really enjoyed it. Thank you. You told me about this before, but I listened and it was very interesting. Thank you. Like for example, when the price of the property goes up, we know that the rent will go up. Exactly, this is what's happening now in Vancouver, North Shore or downtown or many areas, because the price of the properties went up, because the construction costs more nowadays, and because the interest rate is higher. So the price of the property, the value of the property has increased. And because the owner of the property must, as you said, must cover the expenses and all these things and must have a good positive cash flow, and the cap rate, the return on the capital must be positive. So he must charge more rent to be able to basically be in the break-even point or make some money, have a positive cash flow. So we cannot say that renting is better, or based on what I believe, buying is better. But I think buying a property is the biggest investment, is the most important contract in our life. And it is very emotional attachment to basically a property. We have this because it's a tangible asset. We have attachment. We see it, we feel it, and we feel that we own something. So basically, personally, I think the first home, the first property, I always encourage people, buy your first property. If you cannot afford to buy something to live in, don't lose money. Save money for your retirement. Buy a property, for example, in Abbotsford, or like you said, in other provinces. Save that money, buy that property. When you are able, you may want to sell it and buy something in the area that you want to. So for the first property, I am kind of like almost 100% yes, buy. For the second property, if you are thinking about that, okay, what should I do with my money? Should I put it in whole life insurance? Should I invest in RSP? Should I invest in another property to use it as a rental property? Should I invest it in a commercial property, or I buy a business? That definitely depends on case by case analysis. You're expert in that. I do the same thing, not like you with the numbers, but I usually do that for my clients. And we go like deep down to find out that, okay, do you have enough time to manage that? Are you able to pay for the cost to hire a team of managers to do that for you? What do you want to do? And then you can decide. This was basically my, after 20 years living in Canada, knowing, studying accounting, knowing all these numbers, and now working as a financial planner and also as a mortgage worker. This is what I think. It needs analysis. We cannot just say like, oh, everyone is buying. The price of the property is going up. Let's go buy another one. We should know where to buy, what to buy, and other things that are related to our investment.
Yeah. Like whenever I advise a client whether to rent or buy, the goal is always to buy. But it doesn't mean to buy right now. But so one of the things that some people might try to do is if they're renting, try to keep the rent as low as possible. But absolutely think about buying a starter place and then upgrading it after. You might not get the home of your dreams right away, but you don't want to be saving up for the down payment for the home of your dreams. You might be saving up for 10 years. If you can basically get in 1 year or 2 year, but it's smaller, and then you slowly upgrade. That's a way to build equity. I would rent under the conditions of aggressively paying down for a down payment. But if you were holding, if you don't have a down payment, then you have to rent. But if you said, well, Christian, I have a small down payment where I could buy something, or I could keep renting and waiting to buy more. Well, you should work out the numbers. How much longer will you be? If it's like 6 months, a year, that's fine. But if it's another 5 years, then the amount of equity you will have lost based off of the loss opportunity cost will probably be greater than your down payment alone. You might need to save up for a second one. I have never, like, sometimes a client will come to me and say, oh, I have a 5-year plan in order to buy a place. We have some savings. And then I creatively figure out how they can get a place in 1 year, not 5 years, in 1 year. And then sometimes they don't realize that you only need 5% down on places under $1 million. Sometimes they don't realize you could get help from family. Sometimes they don't realize that they could shift some money off of loans, things of that sort. But usually what I find is that the sooner you're able to get into a property, the better. And if you qualify for a large property, let's say a house that has a suite in it, then consider living in the suite and renting out the larger portion, or vice versa, and then moving that way. Like maybe you're a couple with a small child. You'd like to live in a house, and you end up finding a 5-bedroom house, 3 bedrooms up, 2 bedrooms down as a suite. Maybe you start in the suite, and then you get in a better financial position up, and then you shift and trade afterwards. So there's different ways, but some of the things to think about is what stage of life you're at, how much down payment do you have, what do you qualify to buy, and what is your cash flow like. So before you're deciding whether to rent or to buy, the goal should always be to buy. But if you have to rent, you want to kind of strategically figure out how long you're going to rent. So now I kind of want to move to our last topic, and that's on insurance. And both Sima and I are both insurance licensed. And the reason why insurance plays such an important role when talking to people new to the country, as well as talking to people with real estate, is because, to me, real estate is it's like building something. It's like I'm building my financial assets, I'm growing it. It's very, very exciting. I'm buying real estate, I'm buying stocks, but insurance is protecting the assets. So when I think of, let's say I was building a house, well, what would the house look like if you had no foundation, no concrete foundation? Well, the house would look the same. You can't see the foundation, but the problem is, if there's an earthquake, if there's a fire, if there's a strong, wind, the house might crumble, it might fall down, right? It's the same thing with insurance. If I'm a new immigrant and I'm saving up for a down payment, and I buy a house and I have a family and I'm building up all these assets, and then something happens to me, I can't work. Okay, I suddenly can't work. Well, is the bank going to forgive me that I have to take a 1-year break from my mortgage? No, 90 days it'll take possession. So how can I replace the income? We need insurance to make sure that before you decide to buy a place, do you have the correct insurance in place? I have a young family. What if I'm the breadwinner of my family? And what if my spouse, who doesn't make quite as much as income as I do, and suddenly I was to pass away? What happens to the mortgage? What happens to the assets? We put in so much money into this house. Do we get any of that back if we can't pay and the bank takes it away? You don't get any of it back. What would be better is if we had the insurance to pay out the mortgage. And then we're not big fans of bank insurance because, it's a separate talk, but I think a bank, you always want private insurance. You don't want bank insurance. There's a good basic. And for a real estate investor, they says, oh, I want to borrow $1 million to invest in real estate from the bank. Well, the bank is going to say, are you insured for this? Do you qualify for this? What happens if something happens? We don't want your property. We want our money back. So insurance is very, very important. But a lot of people are very confused with insurance. I have some from work. Well, how much do you have from work? Is it enough? Do you have life, disability, critical illness? And which of these do you actually need? So what we find is that we believe that people should do an insurance review, especially if they don't have insurance. If they have no insurance at all, then they should do a review. If you have some insurance from work, you should do a review to figure out exactly what do I have and what does it mean? what is it, a term insurance? Is it a permanent insurance? If it's a disability, how much does it cover you for? So what we're inviting people to do is to talk about doing an insurance review if you are new to the country or if you're thinking of buying real estate, because both of them are going to be triggered over there. Sima, do you have anything to add in terms of the type of insurance that you've been helping, new people to the country with?
The only thing that I want to add is just when we are healthy here for the children, when babies are 30 days, they buy insurance for their babies, for their children. When we are healthy, we buy our insurance, and then we decide about our property, and we decide about going back to financial planning, what we do for people. Do I need RSP? Do I need TFSA? How can I use my RSP and TFSA for my real estate? And also insurance, whole life, universal life, all these things. It's really, as you said, it needs a separate session to talk about it and go over all these kind of benefits of having the right insurance. If something unusual happens, then we have not to sell our property, or we have not to use our line of credit or credit card to be able to pay for our treatment or for our usual expenses, daily expenses. So insurance, we say, is the base of financial plan. It's the base for your financial plan, and then it goes to real estate and other things, and stocks and all other things. So yeah, no, that's definitely, if we want to talk about, you said you basically referred to many interesting points, but I think it needs a separate session to go over all these kind of insurance. And again, going back to what you do and what financial planners do, it needs an analysis. What insurance do you need? How much insurance do you need? What kind of real estate do I need? Where should I invest? When should I buy? And etc.
It's also important if anyone has a corporation set up where they're holding real estate. So if you said, I'm setting up a holding company so I can put real estate inside of it, insurance is absolutely needed, because you'll have taxation issues. And there's so many tax benefits for the insurance being held inside the corporation. So if anyone needs an insurance review, especially like if you have kids, that's absolutely correct. I personally have insurance on my kids. I have a type of a plan where it covers them for life insurance and critical illness insurance. And if they never use the plan for 20 years, so in 20 years, they're all going to be adults, I actually can get all of my money back. So it's the insurance. I don't want to say it was free, because I did have to pay for it, but at the end of the day, all of my money was returned to me. So people don't realize how many great plans there are out there. But what better plan where you actually get the money back and you were insured, or a plan where you're actually putting money in, but you're taking money out more than what you put in, and you got the insurance the entire time. So what you want to do is, if you did want to do an insurance review, I'm going to invite that you connect with us. So I just want to wrap this up to leave time for questions, and just remind you a little bit of what my financial planning is like. Our business model at Latitude West covers insurance and investments. So if you are needing an RSP or a TFSA in order to save up for your down payment, or if you needed an insurance review, you had a corporation, or you just needed personal insurance. We also do planning, but what makes us most unique is we do the real estate. And again, I invite people just to connect, to talk about how we can help. I don't charge anything for us to have an initial conversation. All I would do is help your situation. If you wanted to do an insurance review, Sima and I are happy to do one with you as well together. We would analyze your situation. We wouldn't charge you anything for the review, and there's absolutely no obligation to purchase any of it. It's just information so that you know what the coverage is. So now I'm going to invite people, if they did have a question, you can do one of two things. You can put it in the chat, and we will answer your questions in the chat, or you could take your take the mute off of your mic and you could ask the question. If you do take the mute off of the mic, just a reminder, this is being recorded. So if there are any questions, feel free to put it in now.
Sorry, before we listen to the questions, I just add one more thing. It's just this webinar was in English. I believe, I hope like all the attendees were understood the subject and the material, but in case if you need to have a kind of like a conversation in Farsi, I will be happy to talk to you. And also, if you want to have a kind of like a conversation with Chris, myself, and you, like a group meeting on Zoom, or you have something that you want to discuss, you need some kind of Farsi speaker, at the same time you need Chris, definitely we will be happy to have a meeting and have a conversation with you.
Sure. So their first question has come in, commercial properties. What are the pros and cons of commercial buying commercial property real estate? So I'll start, and then Sima, you could add, okay?
Sure.
So I know I do have clients who buy commercial properties. So whenever you think of commercial property, the thing that I first think of is commercial lending. So commercial lending is a little bit different than personal lending. In personal lending, they look at you very, very carefully. How much money do you make? Can you afford the rents? Can you do all of this? What are your assets? What are your liabilities? Whereas commercial lending, they look a little bit closer at the asset itself. Is this an apartment building? Is it a multi-unit? How much money is it generating? Then they look at you next. Then they'll say, are you considered somebody who would be appropriate to buy this property? Are you struggling with your own finances? Are you all in debt? So maybe it's a good property, but we're not going to approve it for you. So with commercial lending on the multi-unit side, it usually means 5 or more units. So if you found a triplex, three units inside of it, it would not be commercial lending, it'd be personal. If you found something that was 5 units or higher, it now qualifies for multi-unit. So the pros and cons of multi-unit is, number one, in some ways it's easier to qualify for, especially if you had multiple real estate properties. If you had 4, 5, 6 properties, they might not want to lend to you anymore because they feel you're overextended. But that's why a lot of people will get a multi-unit once they have multiple properties. The other thing about multi-unit is there's economies of scale, which means that per door, it's all under one roof. So the cap rates and the cash flows tend to be better with a multi-unit. So those are the pros. I find 2 big cons. One con is that usually the interest rates are higher with commercial. So if you're getting a 6% rate on, your next purchase for your home, and you now want to qualify for a commercial property, you might be getting 7 or 7.5. And that's just standard, which is why you want to work with someone who can run the numbers to see, is this still a good deal? The second complexity con of multi-unit or commercial, they're very hard to find. A good one is very hard to find. It's not like a house. If I want to buy a condo, I'll go out, I'll have 100 different condos to choose from. You want to buy a good 5-plex multi-unit, oh my goodness, it's very, very hard to find. It's like, even if you go out of province, these things are hard to find. It's because there's not as many, and the good ones tend to get snapped up right away. So when I work with clients, we are looking for multi-units on behalf of them. And I know it's significantly harder than if I was just looking for a cash flowing Airbnb, condo. Sima, did you want to add on to?
No, I think it's just the only thing is also when we talk about commercial or commercial properties or buying a business, usually the lender looks at the experience or work experience or business experience. It has happened many times that someone who is, for example, it happened like in West Vancouver, this West Vancouver florist, 30 years in West Vancouver, very successful business. Grandchildren of the families in West Vancouver were going and buying flour and all these decoration items from this shop. And then someone bought that business, and with all the financial statements, fantastic, good income, very good cash flow, everything was perfect. it was less than a year that West Van Florist was closed with a lot of loss, with a huge number of amount of loss. So basically, the buyer look at the financial statements and say, "Oh, okay, that's great, and I have money," and he bought it. But then, when it was to managing that flower shop, which is to me is the most complicated, one of the most complicated businesses, he couldn't manage it and it was closed. It's the same. If you are a property manager, you have experience, you buy a complex or a multifamily building, you can manage it. But if you are not in that business, my job, I have, for example, I'm working as a software engineer. And now, okay, I have money, or I want to, instead of buying a property for my family, I want to invest and buy a family complex and rent it and make money. But am I going to hire someone to manage that property, or am I able really to do that? So these are something that sometimes the banks are not willing to give loans and mortgages easily to people who don't have enough experience in that business. That's something that I can add to your point.
Yeah, and one thing, I'm not sure if anyone is a dentist or a pharmacist or a physician. We work heavily with dentists as well as physicians, and commercial real estate often, if they're thinking of having a practice inside, and owning it versus leasing it, there's some wonderful advantages to doing that, and we could kind of walk you through. So if you were a business owner or a medical professional where there was a possibility where you yourself could actually practice in that building, there are really good options where it actually makes more sense to buy versus leasing the property. So if anyone is in that category, we encourage them to reach out. But I think we're slowly coming to our 1 hour limit, and I want to be respectful of everybody's time. So thank you everybody for joining us. We have Sima and Mai's email there. If anyone would like to book a complimentary phone call or a Zoom call just to go over your situation and to talk a little bit more about how we can help you and our value add, feel free to reach out to whoever is most appropriate, and then we can go from there. So Sima, thank you for your time, and thank you for setting this up. And for those of you who are in attendance, please reach out. And for those of you who are listening to the recording, the same invitation goes out to you. Feel free to connect with either one of us, and we'd be happy to help.
Yes, thank you so much, Chris. Thank you. I don't name people here in case, but thanks all for coming, attending, listening to us, and hope you got something out of this session. And we will be happy to see you and talk to you later.